I'm going to see if I can make a fortune by investing in the cheapest markets out there, and I'm not sure it's going to go well. Investing in cheap markets, it sounds like a dream come true, right? You get to buy into assets at rock-bottom prices and watch your money grow. But is the potential reward really worth the risk? That's what we're trying to figure out today. Investing in cheap markets can be super tricky. One of the biggest challenges is the lack of liquidity. When you're dealing with cheap markets, you're often dealing with smaller, less established companies or assets that don't have a lot of buyers and sellers. This can make it really hard to get in and out of investments when you need to. And then there's political instability. Cheap markets often exist in countries or regions that are going through tough times, which can make it even harder to get a clear picture of what's going on. Another issue is unreliable data. In cheap markets, you might not have access to the same level of financial reporting and transparency that you get in more developed markets. This can make it tough to do your due diligence and really understand what you're getting into. And let's not forget about the potential for corruption or other shady dealings that can come with investing in cheap markets. All these risks can be a major turnoff for a lot of investors. These challenges are real, and they're not to be taken lightly. But at the same time, there are some compelling arguments for investing in cheap markets. For one, the potential returns can be huge. If you're able to find undervalued assets and get in early, you could be looking at significant gains down the line. For example, some investors made fortunes investing in emerging markets like China or India back in the day. Of course, it's not all sunshine and rainbows. There are plenty of examples of investors who got burned trying to chase cheap market deals. Venezuela, for instance, has been a disaster for investors in recent years. The country's economic woes have made it a classic example of how things can go wrong. So, it's clear that investing in cheap markets is not for the faint of heart. So, is the potential reward worth the risk? My answer is that it depends. It depends on your individual investor profile, your research skills, and your long-term perspective. If you're someone who's willing to do their homework, who's comfortable with a higher level of risk, and who's looking at the long game, then cheap market investing might be for you. To assess this for yourself, you might want to consider a few key factors. First, take a close look at the market's fundamentals. Is there a solid economic foundation, or are there some major red flags? Next, consider your own risk tolerance and investment goals. Are you looking for quick flips, or are you in it for the long haul? And finally, think about your research skills. Are you able to dig deep and get a clear picture of what's going on? The bottom line is that cheap market investing isn't a one-size-fits-all strategy. It's not something that you can just do without careful consideration. You've got to do your homework, and you've got to be honest with yourself about what you're getting into. If you've had experiences with cheap market investing, I'd love to hear about them in the comments below. And if you're new here, consider subscribing for more insights on investing and finance.